When you retire, your paychecks stop. The complex billing systems from government agencies, however, do not. Many retirees unknowingly fall into what is known as the passive penalty. The default setting for government billing systems assumes that you owe standard tax and premium rates, unless you actively prove otherwise. Federal tax entities, Medicare administrators, and local municipalities do not automatically communicate with one another, and they certainly do not automatically apply senior exemptions to your accounts. You can legally reduce or completely eliminate 5 specific expenses, ranging from healthcare surcharges to local property taxes, simply by filing the right proactive paperwork. The documents required to stop these financial drains are surprisingly straightforward, provided you know exactly which agency holds them and exactly when to submit them. Accepting the default bills arriving in your mailbox is mathematically equivalent to draining thousands of dollars directly out of your retirement portfolio every single year. The first major institutional leak happens within the healthcare system. Specifically, retirees routinely overpay for Medicare Part B and Part D premiums due to a surcharge known as IRMAA. This timeline illustrates a mechanism called the 2-year lag. Medicare calculates your current premium costs based on the income reported on your tax returns from 24 months ago. This creates a financial trap. Retirees frequently pay high IRMAA surcharges based on the peak earning years of their late career, even though their current retirement income has already plummeted. To fix this, you have to use Form SSA-44. This specific document allows you to bypass the 2-year lag by proving you have experienced a qualifying life-changing event. The Social Security Administration explicitly categorizes work stoppage, or retirement, as one of these qualifying events. For example, a recent retiree facing an extra $200 a month in Medicare surcharges can submit this exact form, prove their income has dropped since they stopped working, and see an instant reduction in their monthly healthcare costs. The government will never proactively correct this overpayment for you. You must submit the form and trigger the recalculation yourself to capture the savings. At the federal level, the tax code offers baseline relief right away. Individuals age 65 and older are legally entitled to an increased standard deduction, which immediately lowers their baseline taxable income. But the true complexity lies in provisional income. This formula determines exactly when your Social Security transitions from a tax-free benefit to taxable income. It is calculated by combining your adjusted gross income, your non-taxable interest, and exactly half of your Social Security benefits. If that total provisional income crosses $25,000 for a single filer or $32,000 for a married couple, a portion of your Social Security becomes taxable. Retirees who cross these thresholds often fail to account for the tax liability, resulting in a surprise bill in April. You can prevent this by submitting Form W-4V, which allows you to establish a voluntary tax withholding directly from your Social Security checks. Proactive retirees use specific tax strategies to keep their provisional income below those thresholds. Utilizing the 0% capital gains tax bracket or taking advantage of the home sale exclusion allows you to generate cash without unnecessarily inflating your adjusted gross income. Measured. Another method is the qualified charitable distribution. This allows you to satisfy your required minimum distributions by transferring funds directly to a charity, keeping that money entirely off your tax return. Managing provisional income requires planning your withdrawals strategically. By controlling exactly where your cash comes from, you protect your Social Security benefits from the IRS. While federal taxes are uniform, local property taxes represent the most volatile threat to a fixed income budget. Assessed values can spike aggressively year over year. To combat this, thousands of municipalities offer circuit breaker programs, homestead exemptions, and senior property tax freezes designed specifically to cap or reduce the amount owed by older residents. The eligibility requirements for these programs are stringent. Income limits, residency duration, and age brackets vary drastically, not just from state to state, but from county to county. The most common error retirees make is missing the strict, unadvertised filing deadlines at their local assessor's office. Missing the cutoff by a single day results in losing a full year of savings. When successfully applied, the results are immediate. An income-based circuit breaker program can take a property tax bill that has doubled over a decade and legally freeze it at a fixed baseline for the remainder of a retiree's life in that home. Navigating local property tax relief is a highly localized maze. Securing these exemptions depends entirely on investigating the specific rules of your county assessor. The sheer volume of paperwork required to execute these strategies often drives seniors to hire expensive CPAs, effectively paying high fees to capture their tax exemptions. There are free, government-backed alternatives designed to handle this exact administrative load. Programs like IRS Tax Counseling for the Elderly, AARP Tax Aid, and Volunteer Income Tax Assistance exist specifically to prepare these documents at no cost. Access to these programs is generally based on age and income limits, with most services geared toward individuals aged 60 and older or those making low to moderate incomes. Securing this free administrative help ensures that the money you save from government exemptions stays in your bank account, rather than passing directly to a private accountant. Successful retirement finance requires shifting your focus. Instead of solely tracking your investment ROI, you have to prioritize your return on forms, a risk-free method of retaining wealth through administrative precision. The burden of proof lies entirely with you. These large bureaucratic billing systems will gladly accept your overpayments indefinitely. Start by pulling your most recent property tax bill. Go directly to your local county assessor's website and search for their specific senior exemption forms and deadlines. Next, review your latest Medicare Part B premium statement. Look specifically for an IRMAA surcharge listed on the breakdown of your costs. If you are paying that surcharge and you have recently retired or experienced a drop in income, download Form SSA 44 immediately. Optimizing a fixed income requires rejecting the default path. You protect your assets by taking active control of the administrative levers the system makes available to you.